Hi, this is Carey Brown with eXp Realty, and you're listening to Real Estate 101. I am here back again with Kim Penrod with Fairway Mortgage. Hi, Kim.
Hello.
So we've been breaking down different loan products. The goal is to get you to where you understand each one. So we've done FHA and VA. Kim broke down, what you would need. This particular one is down payment assistance. And so Kim, I'll just let you start.
Okay.
Obviously we've broken down in the other shows what you would need, but let's kind of hit the highlights on that again.
So down payment assistance will kind of piggyback off of FHA and conventional. You can use down payment assistance on both programs. It is what it sounds like. It covers your down payment. So let's just use for an example, if you're doing an FHA loan and you're putting down 3.5%, this program will gift you that 3.5%, so you don't have to pay the down payment out of your own pocket. And it truly is a gift. It's a grant. You do not have to pay it back. There is no recapture tax, which some of the older down payment assistance programs had a tax where if you sold the home within the first 3, 4, 5 years, you would have to pay back a portion of that grant. This one does not have that at all. So if you bought the house today and let's say 12 months, you needed to move out for whatever reason, you would just sell the house and pay off your mortgage. You would not have to pay back this down payment assistance. You do have to qualify, meaning you have to have at least a 640 credit score. So remember, on FHA, we can go down to 600, but if you're using down payment assistance, your score has to be 640. So it has to be a little bit higher. With that, your debt to income ratio cannot exceed 45%. So sometimes on FHA, we can go up to 50% with a debt to income ratio, but on down payment assistance with a 640 credit score, we are restricted at 45. The only thing on the down payment assistance is the interest rate is a little bit higher and the fees are a little bit higher. So if FHA is at, let's just say 3.25 today, just straight FHA with you paying your own down payment, the down payment assistance rate is going to be about 1/2 to 5/8 higher. So probably 3.75, 3 7/8, somewhere in there. Which that's still great because the benefit outweighs the increase in the rate. And then fee wise, on 100,000, the fees are probably $1,500 to $1,800 more than if you did straight, again, paying your own down payment. Now, as far as the fees, so let me back up a little. You have to put 3.5% down on an FHA loan. With the down payment assistance, you're actually getting a 4% credit. So half of that can go towards that extra fee, and the other 3.5% can go towards your down payment. A lot of that's probably more than a lot of people want to hear until they're at the point where they're ready to make the application. They just want to know they're going to get their down payment covered. On FHA, again, the seller can pay up to 6% of your closing cost. So there is a chance that if you did down payment assistance that you may have to, or you may walk away with hardly paying anything for closing. The down payment assistance would cover your down payment. And if the seller agreed to pay your closing cost, then they could pay all of them. And you would only have to pay your earnest money up front, which we talked about that a little bit before, and your appraisal fee up front. And then you could get those back at closing. So if you put $1,000 down for earnest money and paid your $500 appraisal fee, you could get that. There's a chance you could get that $1,500 back at closing and then not have to pay anything to buy a house, which would be a great deal.
So is this in Kansas only, or is it in other states?
The whole state of Kansas. This program is, it's called Kansas Housing Assistance Program, KHAP, and it is only in Kansas. but you can do this program in any city in Kansas. It's not just Topeka, not just Shawnee County, it can be any county. Now, FHA does have an income limit. I had to write it down because I knew I would remember. It's 108,000. So that's pretty big in my mind. If you make less than 108,000 and have a 640 credit score, then you can take advantage of doing the down payment assistance on FHA. Now I'll flip and move to conventional because you can do this on conventional as well. So if you've not owned a home in the past 3 years, you can do a conventional loan and only put 3% down. If you've owned a home in the last 3 years, you can do a conventional loan, but you have to put 5% down. If you wanted to take advantage of the down payment assistance, you can do that on conventional and get, again, a 4% credit. So really, if you are required to put 5% down, you're still going to have to put some out of pocket down, 1%, because you'd only get a 4% credit from the down payment assistance. But let's say you were first time ever buying a home and you were doing the 3% down assistance. You could get that 4% credit. 3% would go to the down payment, and then the extra 1% can go towards the extra fees. On the conventional side, the income limit is 61,600. So it's quite a bit less. So if your income is more than 61,600, then we're going to want to look at doing an FHA loan because we can go higher on the income. Again, credit score has to be 640. Now on conventional, when you're putting 3% down, the seller can only pay 3% of your cost. So that's one of those situations where, let's say I have a buyer and they qualify for both programs. I usually will send them both estimates so they can see which way that would be best for them. Because remember, on conventional, that private mortgage insurance can be canceled once they have 20% equity in the home. FHA, they can never cancel the private mortgage insurance. They would have to refinance later, get into a conventional loan to get rid of that PMI. So really, if it's someone that says, I'm probably only going to be in this house for 5 years, then let's just do FHA. You can get more in seller pays, and really you wouldn't worry about the PMI because you're going to sell that house in 5 years anyway and get a different house and then do a conventional loan probably. Were you going to ask me a question?
Yes. Are there any rules against turning a house into a rental? Obviously with FHA you can't.
Right.
Understand that correctly?
So with the down payment assistance, they do want you to occupy the home as your primary residence. You're going to sign a note stating that you're going to occupy that home within 60 days from closing. They do not state that you have to be in that house for a certain amount of time. So if you got the down payment assistance and you were doing a conventional loan, and let's say after 2 years you decided to make it a rental, you would be fine. There's not anything that you're signing at closing that says you cannot use that as a rental. Now, FHA, they want you to occupy the home as your primary residence, so you kind of have to be careful there. I've heard of people doing it, having an FHA loan, and then turning it into a rental later, and they have no problems. Just don't not make your payment. If you give them reason to check on you, that's when they're going to want to know, why aren't you living in the house? You're doing an FHA loan. You said you're going to live in this house as your primary residence. But if you keep making your payment on time and don't give them any reason to check on you, they're probably not ever going to know that you don't live there. I'm not saying do it. I'm just saying be careful.
You may not get caught.
Right.
So let's just say you do get caught. They can call your note due based on their rules, right?
Right. They can call it due and payable on demand is what it's called. And that means you've got to pay that note in full right away. So you'd have to scramble to find a lender that would be able to do it's called an investment property loan. Again, let's just use 100,000. If you're buying an investment property, you'd have to put 20% down. So in that situation, we would do a refinance to pay off that other loan, but you'd have to have at least 20% equity in order to be able to do an investment loan. The rate's a little bit higher. They want you to have more skin in the game. So that's why they require the 20% equity.
We had recently, it was our listing, and had a buyer call in and basically was under contract. And what we found out was that he was really an investor trying to do an FHA loan.
Oh, yeah.
And Kim had to educate him on how that isn't going to work. And
No.
have to put 20% down. And of course, he didn't have the 20% down, which is the reason why he tried to get the FHA loan. So
exactly.
Yeah, new real estate agent on the other side, didn't know to ask the questions. And you have to trust your clients.
Right.
And if you don't know to ask, they don't get tripped up until they get to the lender.
Then you get messed up right away. Yeah. And then they call and they get upset because, well, why can't I just do 3.5% down? And the lender won't do that because you're not living in the house as your primary residence. Those loans are specifically for people to live in the home, not to be buying investment properties and then make rental income and so on and so forth.
Right.
Right.
So no defrauding the government.
Yes. Yeah. Yes.
Rules for a reason.
That's right. That's right. We don't always like the reasons, but we have to follow them.
So what is the downside of getting a grant other than having a higher interest rate?
That to me is the only downside, would be the higher rate and the higher fees. Now, if it were my child and they were able to find a home where the seller would pay the closing cost, I'd say take it. That's free money. I mean, in a way, you're paying a little bit higher in the rate, but especially if it's someone that won't be in the house for maybe more than 5 years, or that if they're starting with an FHA loan and they say, no, I'm going to be here probably for longer than that, well, then just know we're going to have to refinance you later. And then you can refinance and get a better rate. I mean, still, even with the higher rates are low. Even anything under 4, anything even above 4, if you're under 5, it's just, that's still low. So I would take advantage. I still think it's a great product, especially when you have someone that doesn't have the money. If they don't have down payment money, that keeps them from buying a house. Many people don't have family members that can gift it to them. They don't have access to retirement or savings. So this is a great way to get someone into a home and get them out of a rental, so they're not paying rent and making someone else richer.
Yeah,
Right,
absolutely.
right. I always believe in homeownership because you're building your future. No one wants to work their whole life. And that's one expense you will have your entire life. You're going to have to live somewhere. So why not pay yourself instead of paying rent forever?
Absolutely. And then, whenever you go to sell, you get that money back, or you just take care of it.
That's your equity.
Renting. So
exactly.
You just paid for somebody else to be able to sell and take the equity.
You do. You totally do. Yes.
Awesome. So thank you for that. We're going to do another one here shortly about rural development. So we're going to explain.
Sounds good.
So thank you, Kim.
Thank you.
Fairway Mortgage. Kim, how would they get a hold of you if they were
yes.
in a loan?
My cell phone number is the best way. You can call me on that anytime. That number is 785-640-1700. I can take an application from you over the phone. Or I can direct you to my website. You can fill out an application online. And you can text me also if you'd rather text. That is great as well.
Awesome. And if you're looking to buy or sell, our number is 785-213-5188. Thanks for joining us on Real Estate 101.